Good evening, everyone. Let's do a quick sound check. If you guys can hear me, just give me a quick shout out. I hope everyone had a good trading session today. It was the last trading session of April, and there was a lot of good moves in the market today. So I hope all of you could capitalize on that and make the most out of the trading situation today. Right. So let's go onwards. Today's session, we've called to speak about the volume point of control. Right now, this is a subject, which is I like all things about volume, and knowing volume point of control has made a lot of difference to the way I've done my trading over the past 15-20 odd years. Right, so understanding this subject is critical, and if I were you, I would pay careful attention and ask questions. Right, so this is going to be a two-way interactive mode. Of course, I have the mic with me, so I'm going to be the one talking on the mic, but I want you guys to interact with me. I hope you learn a bit from this session, and I do hope to learn a few things more based on the kind of questions you would ask me. So I'm looking forward to your questions, to hear from you about how we understand this together. Right now, volume point of control is basically a term which we use from the volume profile. Right now, the volume profile came into being after the market profile. Now, the market profile is the chart which you are looking at on screen right now. It's the TPO based market profile, the original market profile, which was started by Pete Stedelmeier, later promoted by James Dalton. And that is what has made the big difference to at least the way I approach my trading. Right, around the time Pete Stedelmeier and Jim Dalton were introducing the market profile to the community at large, volume was not there in the markets. Right, the exchanges at that point of time did not really give the component called volume to any particular chart. So if you look at what Jesse Livermore and all these big guys, the Dows and the Merrills and everybody else, they were primarily they were price based traders. They trade off the ticker of the price which was out over there, because the exchanges did not give volume at all. Now that changed in 1992 when the exchanges first started giving volume information on charts, and after the volume information came about a lot of tools based on volume. Volume profile was one of them. Without that, the earliest market profilers traded of the market, and they had this price and time thing which they were looking at. And to get around this component, or to get around this handicap, because the exchange was not giving volume at that point of time, they devised the formula. And that formula was simply this, that price into time was volume. So you took price, you multiplied it by time, and price into time came together, and that is what created volume. And it was a simple piece of logic which they used at that point of time, purely because if price spent a certain amount of time at a particular price at a particular place, and the volume became a byproduct of that transaction which happened between price and time. So that is the formula they had for inventing this term called volume, when volume information was not given by the exchanges. Fast forward to where we are in 2024. We not just have volume, we have volume profile as well, and now we have gone further. We are looking at volume within the bars, and that term is also called the order flow of the market. Right, so we've gone from being market profile traders to volume profile traders, and the most advanced version of looking at all the buying and selling which is happening in the market is the order flow of today. So it's just a step-by-step advancement of the understanding that market profile has grown with the advent of volume. Right now, where do we get a volume profile chart, and what is this study of VPOC all about? So I'm listening to you, I'm reading you, as we go along. I have a tab open, which is gonna look at your questions as they come in. So feel free, to ask me any kind of questions as we move along, and hopefully I should be able to answer all of those questions you have. The chat tab is open. You can ask any kind of questions you have over there. Right now, what do I do first is I have a market profile chart open, and you can get to a market profile chart by simply clicking on the left, and the one at the very top, market profile charts. That's where you would get a market profile chart open. Now, where do you get your volume profile from? So if you look lower down, right over here at the extreme left bottom of the row, I think my page setting is preventing you from looking at it. But if you open up any market profile chart, you would get a T, a V, a T/V, VVN, TVA, etc., at the very bottom of the chart. Now, when you click one of that, you go from TPO to these volume bars on the right. Right now, this is the volume profile, and if you do not want the TPO at all, then you can choose this option. Now this takes away all the TPOs, and what you have is a volume profile chart. So it simply means you're looking at volume next to the price bar. And this is the volume profile of today, and it represents the zones where price traded, where volume traded alongside price next to the price. Now a distinction needs to be made over here between looking at volume below the bar, which is the conventional way of looking at volume. Everybody plots volume below the price bar. Volume profile is about plotting the volume next to the price bar. Now there are several advantages of doing and approaching a market or approaching an instrument this way, and we're going to be talking about some of those advantages as we go along in this session, right? But this is a volume profile chart. So what you get is basically you get the volume right next to the price, and it gives you the shape of a profile. You also get a volume histogram to the left, which is this. This is a volume profile, and it simply is a sum of all the volume which is traded in this particular price. So it sums up all the volume of all these profiles, and it gives you this representation out over here. Right now, why am I mentioning this? Because what we are going to be speaking about today, is going to be based on the volume profile, and we're going to be taking out the most important part of the volume profile, the volume point of control, and trying to understand what this information is all about. Right, so I'm reading you, and I can see some of your questions coming in. Right, we'll take the general questions later in the session. For now, the topic is the volume point of control, and I'll really appreciate if we all stick to this topic and try to understand this concept called the volume point of control. I'll take all the remaining questions you may have towards the end of the session. We'll do a Q&A, and then we'll open the forum to general questions. But for now, keep your questions restricted to the volume point of control or volume profile and what we are discussing at the moment. Right, so this is the volume profile, and if you can see this particular profile of today, there will be some zones over here marked in pink. Right now, these are what we call HVNs, high volume nodes, and the biggest of those HVNs is called the VPOC, or the volume point of control. Simply put, it represents the zone where the market put in the largest volume that day. Right, it's the largest concentration of volume in that day. So this is the Nifty April futures for now, and you can see this pink line over here, and you will see correspondingly this market has put in this largest volume at 22,574 April futures today. Now there will be a different volume, okay, for an option. There will be a different volume for another futures contract. Everything, okay, needs to be read over here. So it was previously here in this zone at 22,470, but towards the close, okay, it's migrated to about 22,574. Now, this is the most important piece of information you get from a volume profile chart. Now, what does this information mean to you and why is this significant? Simply put, it means that all the buyers and all the sellers came together and traded the maximum, okay, at this price today, 22,574. That is the definition of a volume point of control. Now, why is this significant? The largest concentration of trading today happened at 22,574. Now, what is this largest concentration of trading? This is simply the buying and selling of the market. That means in this particular volume or in this particular price point of 22,574 today, there was the maximum number of both buyers and sellers in the market. And you can say the same thing, okay, for this 22,470 from yesterday. This was the zone where the largest amount of trading took place. Now, why did the largest amount of trading take place over there? Because the general consensus was that this was agreed as fair value of the day, or the fair value of the market for that day. That is why traders like to trade over there, and that is why they exchanged trades over there, or a lot of buying and selling happened at this particular point. So in this zone, okay, the day before on the 23rd of April, the largest volume concentration is 22,380, right? So what we are doing is we are zooming quickly across this chart and we are just trying to find out where the largest concentration of volume is. Now, like I said, okay, this is the Nifty. So let's look at Nifty May of today. So I'll pick up the Nifty 30th May contract. And I'll again, okay, go with a volume profile chart. I'll look at all those TPOs, and the volume concentration in the May contract today is come at two places. It's this one at 22,500, and there is another one significant, okay, right near the close, okay, at this. Right now, there can be more than one volume points of control in the market. It's not needed, okay, that there is got to be one. The one which we picked up as a volume point of control is the highest, right? But when you look at a mountain range, there's not always, okay, one mountain which is standing over there. Sometimes, okay, in the range, okay, you'll find another small hill right next to it, or something, okay, which is slightly smaller than it or slightly taller than it. Okay, that is the definition, okay, of the volume profile. So you pick up the largest, but you also, okay, pay attention, okay, to where, okay, it was previously, and what is the kind of movement, okay, which has happened, okay, from the previous one, right? My way of looking at the volume point of control is not just to identify one area, but the closest three zones in the market where the market traded the maximum volume, and also to find out why, okay, something, okay, shifted during the day from one point to the other point, right? So just one key takeaway over here: volume point of control is the largest concentration of volume in a particular instrument in a particular session. We pick up that range, okay, and what we do with it, I'll explain to you in a bit. But I do hope, okay, that you understand, okay, that this is the zone where buyers and sellers agreed as a fair price in the market, and they agreed, okay, that this is the zone, okay, which is going to be important for them, okay, to take positions out of. So till now, okay, if you have any questions, okay, please feel free to shoot before I go, okay, on to the next phase of this, next step of this. Anyone, any questions? So I hope, okay, I'm clear, okay, I'm explaining, okay, these concepts, okay, to you. Now what we'll do is we'll zoom out, okay, of the chart, and we'll look at areas where the market has traded before. So for instance, today's rise stopped where the volume point of control was on the 5th of April. This is the 30th May Nifty. Now, was this level significant? Why did the market stop over here, right? And there is another level, okay, significant over here, which is the 22,747, 746, which was, okay, before, okay, we had that small gap down open up over here, right? Now, what are these references, okay, and why do we need to pay attention to them? Because like I told you, the volume point of control is the zone where the largest concentration of volume is. That means maximum buyers and sellers traded at these zones, right? Now it flows, okay, from that if the largest number of traders, okay, traded at this particular point or this particular point in the past or in this particular point in the past, some of those trades are profitable, okay, driven, okay, by market, and some of those trades are not so profitable, okay, that means they are in loss. And at some point in time, some of the buyers, okay, who kept that position are in profit and they will book profits, and some of the sellers, okay, who are making a loss, okay, will quickly, okay, book a loss so that okay, they are prevented, or they are a bigger loss, okay, is prevented, and the account, okay, is kept, okay, from deteriorating further, right? For that matter, okay, for this instance at 22,746, because I know there is a large number of buyers and sellers over here, and for the sake of an argument, okay, let's just assume that there is a 50-50 match, okay, between buyers and sellers at this particular price of 22,746. Now the next day the market gaps down. The next day the market gaps down. Who is profitable? The sellers of this VPOC, right? And of course, okay, everybody else, okay, at the top of this profile also, but the sellers in this zone, okay, are more profitable. Who will hold their position? The seller, because, okay, there is no pressure on him. Okay, the market is going his way, there is no pressure on him, the seller will hold his position. What happens, okay, to people, okay, who were buying over here at 22,746? The market, okay, went against them. Now, okay, they are what we call upside down in the market. Now, okay, they have to close their position in the market, right? And because, okay, they are closing their position, okay, you see the possibility of a bigger fall coming, right? You are alive to the possibility of a bigger fall coming. Why? Because, okay, you're exposed, okay, to a set of data which tells you that a large number of traders entered a position which was either long or short at 22,746, but because the market gapped down next day, some of these positions are upside down, and because it was a strong VPOC, some of them would close, creating a further move down. So this particular day, the market, okay, went down even further right up to here, and went down further after that also. In fact, okay, even this volume point of control was not taken out in that next session. Are you following me up to now? Any questions, okay, so far? Have I coming across? Yes, no? Am I coming across? Okay, we'll explore, okay, those concepts of acceptance and rejection later, but for now, okay, for beginners, okay, we are just looking at it as a volume point of control, right? So I'm reading you guys, okay, let's do this as a two-way interaction, and if you got any questions, okay, please, okay, engage, okay, with us, okay, directly on the chat. I'm happy, okay, to answer all your questions, provided, okay, you stick it, okay, to the same topic for now, which is the volume point of control. Right now, there is also a VWAP in the chat, in the chart, and VWAP is this green line, right? So I'll zoom in, and let's take, okay, any day. So in all our charts, what you get, okay, is this pink line, okay, which I say is the VPOC, volume point of control. You also get the green line, which is the VWAP. Okay, now there is a question over here, okay, which is more significant. Okay, now the VWAP is the average of price, volume weighted average of price. That means so all the trading which happened that way, price wise, the average of all that came over here, which is this green line. What is the VPOC? VPOC is the largest concentration of buyers and sellers in that particular session. Now, I am not focused, okay, on the average price. I am focused on where the market activity is the highest. And there is a relation between these two, the VWAP and the VPOC. And if we get enough time, okay, I'll discuss, okay, that relationship, but it differs, okay, based on, okay, what has happened activity wise, okay, within this bar, right? So let's leave VWAP out of this. VWAP is a completely different study, though it is on the same chart. What we are talking about right now is the volume point of control, which is the largest concentration of volume in that bar. The majority of trade has happened at this pink area. And the single biggest takeaway, okay, of all these charts is for you, okay, to focus on where the majority of trade has happened. And for you to understand whether this majority of trade is profitable or the majority of trade is upside down. Let's look at, okay, some option examples from today. So I'll go, okay, to the 22,400 PE of today. And again, okay, let's go, okay, to the volume profile only. So there was a big incident in the 22,400 PE around 11 o'clock in the morning. I put out a tweet also and we discussed this. So this is the volume profile over here, right? Now, we know, okay, that the 22,400 PE, okay, was being written. We know, okay, the 22,400 PE was being written, but from where was, okay, this writing happening, right? So one was, okay, at this zone 187. This is the largest concentration of volume. Some writers, okay, came in over here and they are 100% profitable for writing over here. Of course, okay, you can say that there were some buyers also over here, but a majority of them were writers and they are profitable. And I'll tell you why, okay, they are writers also. Here also, you can see, okay, the largest concentration of volume is here around 100, and they are also profitable. In fact, today's spike, okay, just went up to here. It almost, okay, touched all this writing and it came down, okay, and further, okay, went down to zero, right? Now, there is another useful method which we have of seeing this in charts, and this is what we call the line chart. So what I do is, from the top of my menu, I choose the fourth option. So market profile, order flow, and you go to line charts. And when you click line charts, the default setting over here is 1 day, but I wanted to take the maximum, okay, which is about 6 days. Okay. And then this particular chart, okay, which comes to you has got all these elements: VWAP, VPOC, OI, volume, and price. Now, what I'm going to do, just for the sake of explanation, let's strip out, okay, all the other things, and yeah, let's look at this one over here, right? So this is a price bar, okay, which is going up. Okay, we have the VWAP of the day, which is this green line, and this is on a per day basis. So the way, okay, we approach VWAP is very, very different, okay, from the conventional way, okay, which VWAP is done. For us, okay, VWAP, okay, which is sliding up, has got like this one going up at a great angle, is got a lot more significance, okay, than a VWAP, okay, which is flat like this. This VWAP is of no consequence to us. So there is a lot of quality inside VWAP also. Okay, and maybe, okay, we can have this, okay, for another session, okay, maybe sometime later. But a flat VWAP has got no value for most activities in trading, except, okay, if you are a 100% writer, of course, then this is a very good VWAP for you, for you as a writer of positions. But an ascending VWAP or a declining VWAP is got a lot of significance. And today's, okay, session is not on VWAP, but we will try to talk about it in some other sessions, right? And I have this pink line, the same pink color, added to the same chart, and this is the volume point of control over here, right? We also have the open interest, okay, which is added up over here. What I'm going to do is, for the sake of simplicity, let's go, okay, with it from, let's go with it, okay, with an option instrument. Right. So I have a 22,400 put on screen. And let's start again. I'll strip out all the information, even the IVs, and let's take out the open interest also. So this is a price chart, okay, on screen, and you can see, okay, that the 22,400 PE was somewhere around 570 at the start of this series. About 10 days back, it's now about 0. Okay, so it's slid down. We'll add VWAP to it, which is this green line. Like I said, okay, a sliding VWAP, okay, tells me that the sellers are in control. Flat VWAP, okay, is basically an intraday market going flat. And I'll add this volume point of control over here, which is this pink line. Now I'll zoom in. Now, just a clarification over here. These charts, okay, we are using, okay, for the current weekly time frame. Okay, and it's very, very important, okay, for all of us, okay, to know that and understand that, okay, we are looking at things, okay, from a weekly series point of view. So I'm not really interested, okay, what happens, okay, at the end of May. I'm not really interested, okay, what is going to happen in June. And there's no conversation here about what the market is going to be in December or January or next April. All I'm interested in is what the market is going to do today and about 5 days from today. Weekly series, where it closes is important for me because that decides, okay, my MTM. I'm really not interested in, okay, what the market is going to do Friday morning at the open. I'm worried, okay, about this Friday morning to about a Thursday evening kind of close for the Nifty, and then, okay, from Thursday morning to about a Wednesday evening for the Bank Nifty, or Wednesday morning to about Tuesday evening, okay, for the Fin Nifty. Right, so I'm very, very clear, okay, that these are the charts, okay, which we are looking at, and this is, okay, what we have. Number of days, okay, we'll be looking at is 6. Right, now think of this as okay, say, okay, you're going to the airport, okay, and you have your ticket, okay, in your hand, and all those people, okay, at the airport, their job is just to make sure, okay, that you're catching the right flight. Right, so if you have to go to Delhi, they will ensure, okay, that you do not take the flight, okay, which goes to Kolkata or Bangalore, okay, for that matter. Right, so all those people, right from the security at the airport to those check-in counters to the second level of security, everybody, okay, just checks, okay, where, okay, you have to go, and that you're hitting the correct gate and that you're boarding the correct flight. But you need to also know, okay, which flight you are taking. Right, so that's why, okay, we say, okay, what you're looking at when you're looking at information from the market, be very, very clear about the gate, okay, you are taking, okay, for your flight. Okay, because, okay, if you do not if you're not clear, okay, about the flight, okay, you may, okay, catch the wrong flight and you may go elsewhere. Right, there is a lot of information in the market. The information for the weekly series, okay, is different, okay, from the information from a monthly series, and you cannot extrapolate, okay, information from the weekly series and take it to the monthly series. You're catching the wrong gate and you may catch the wrong flight also. Right, so look at, okay, this in terms of a 6-day window, look at this in terms of the series, and we'll be focused on where this is for the 25th of April. So in this, the VPOC, okay, first started here. The largest concentration of volume on the 19th of April was at this zone, very high. Right, then they started writing here around 300, then they started writing over here around 150, then, okay, they started writing here just about 111, and today's writing, okay, was happening at about 50-55 odd levels. You can zoom in and have a detailed look at this particular chart also. So you can use, okay, one of these cursors at the top and have a more detailed understanding about where this is happening. Right, so this POC was at this level at the close. It came down, was at this largest concentration of volume, came down, price spiked over here, but was steady around here, and finally, okay, they got it at 0. Right, so this particular zone where the previous VPOC is, sometimes, okay, becomes a hugely significant demand or a supply zone. Sometimes it becomes a hugely significant demand or a supply zone. So there's no need of a random calculation required by you to find out, okay, where is the zone, okay, you need to put a stop loss, or where is the zone, okay, you need to put a target. The market profile, the volume profile rather, will give you this information if you're really good, okay, at finding, okay, where these levels are. Right, so this became a resistance zone later. It was a VWAP, but it was also the volume point of control, okay, from before. This volume point of control gave resistance, okay, to this probe, okay, which was high, going upwards right? And so on. Okay, this became okay resistance okay for the market at 30. Later on, after 1 p.m. and the market okay never probed okay above this level for the rest of the day. So what we are saying over here, is that if you look at where the market is traded, okay, this is market driven information. If you look at okay where the market is trading right now, and you have an understanding about what it has done previously, the volume point of control becomes a important level okay to for you okay to find out where the supply is, or where okay the next support is going to be. So if you are, for example, okay trading, let's say, the 22,600 PE of next week, 2nd of May. Right now, as this chart loads and we go into that 22,600 PE of next week, okay, you would be just focused okay on where the important zones are for that particular series, right? So we'll go to this chart in a bit over here, but let's stay okay with 25th April for now. Just as an example, let's go with the 22,600 PE. Okay, right. So let's go okay with this one, 22,600 PE. So on that probe up, if I was looking okay for a zone okay to put my stop loss, it would be a little bit above this volume point of control, because it had to okay give you resistance at this volume point of control. Likewise, okay, this was a support. Okay, and once the market okay decided okay to trade below this pink horizontal line, there's a lot more okay writing okay which came in the market, right? The simple point over here is this is the VPOC, the volume point of control. It's a zone where the market has traded previously, and not just a nominal amount of volume. It has traded okay a very large amount of volume between buyers and supplies. So instead of choosing a random level to put your stop loss or to put a trigger, why not use market generated information and information okay from the profile to tell you okay whether your particular stop loss is a good one or not, right? So if the market has given you a level of resistance, then the market okay will respect okay that level of resistance. If the market has given you a certain level as a support, the market okay will respect okay that level okay as a support, because this is market generated information. It's not okay derived of 1 by 2 by 3 divided by 4 kind of a formula. Okay, it is basically okay information which the market is telling you that buyers and sellers traded off. So it is a market weighted information. So every time okay you see this and price goes there, you can consider okay that this particular zone okay is a resistance for the market. I'll pause okay for another round of questions over here. If you have any, okay, you can feel free to ask. Okay, so I'm looking at the 22,500 call, the 22,500 call, and I have 6 days okay marked out over here. We were actually okay trading off the 22,400 CE, but there was a very interesting okay development in the 22,500 CE as well. The open interest was rising, and then okay it dropped into the close. So the first thing okay you look at is in the CE over the past 6 days, where has the market okay traded the maximum volume. So if you go okay from your left, from the 18th of April, you'll come okay to this level okay of about 65 or 70, right? What does that tell you? That tells you okay that if these were writers, and I'm still using the word if over here, and the assumption is okay that's 85% okay these of them are writers, the price okay at which okay they have entered is this price called 65, right? And some of them have written okay at about 15 rupees right here, And on the 23rd and the 24th, some of them, okay, have written at 50, 55 rupees over here also. So over the past 3 days, if I had to look at only 3 days of data, I now know that some of these writers were writing at about this price, roughly, okay, about 55 or 60. Okay, I can zoom in and give you a correct level also. In fact, okay, let's do that. So this level is about 50, right? And the largest concentration of trade has happened, okay, at this level of 50 over here. Now, what do you think, okay, is going to happen to all these writers if they see that price is gone up above 50? Anyone? What do you think is going to be their mindset if they have written something for 2 days at 50 and suddenly, okay, find price above 50? What do you think is going to happen? You saw it happening live over here, right? They have to cover. And this is, okay, what happened the minute, okay, it probed above 50, it got tested over here. They said they thought, okay, it would go in, but on the second attempt, okay, it went straight up to about 145, 150 and more, right? So this is the importance, okay, of knowing, okay, where the market has traded before, where the market has got the largest concentration of volume, and this helps you, okay, to get on the right side of trades and not put random stops or approach the market randomly. So I hope, okay, this is clear. They were forced to cover. This blue line is the open interest of the market. All this green, okay, which is coming up over here is the written spikes, the OI spikes, and all these pink lines are examples, okay, of the market covering quickly, right? So there is a true process at work over here. And what we see over here is that there is nothing called randomness in the market. Everybody who trades, and when I say everybody, I need to qualify that, okay, with one word, okay, every professional trader who trades, okay, trades with a plan, trades with a strategy. And if that plan goes wrong, they also have a backup plan, a plan B. And all good traders, okay, work with a plan A and a plan B, and they have an exit mechanism in place, right? But there are traders, okay, who just post or trade randomly all over the chart, and those are the traders, okay, who end up, okay, making the maximum amount of mistakes, right? I'll pause here, okay, for another round of questions. Okay, please feel free to shoot, okay, your questions. I'll take some more questions. Any more questions, guys? So this is the chart, okay, you will get here under line charts, and it's very, very significant to chart, okay, for all of us, okay, because we trade in a lot of options. We continuously, okay, look at this chart we continuously, okay, look at this chart, okay, with respect to, okay, where the market has put previous positions. And knowing, okay, where the market has put previous positions gives us a lot of advantages in terms of understanding what the market can do next. Right. So the question is, how do we combine market profile TPO with volume-based TPO? It's actually the same study. There's no need to combine. In fact, okay, we have made it, okay, very easy for you. If you go back, okay, to the lower bottom, you'll find a T. If you just scroll your mouse over, you will understand, okay, what these T and TVs are. So just combine, okay, the volume profile and the TPO. It's the same information, okay, which will come to you. The shape of profiles also are the same, right? So the chart, okay, where I was previously is the line chart. And as long as, okay, you can stay, okay, to a 6-day window, because, okay, that's the current default template, okay, we have for this chart, you can get a lot of information about what the market has done before and what it can possibly do next. So the question is, okay, how do we determine the strength of the VPOC? For that, you will have to, okay, go through the advanced version of volume profile, which we call the order flow. Right. So if you really want to take this deeper, okay, a higher study is available, okay, for the person, okay, who wants to trade okay, professionally, or wants to grow one level higher. So this is simply your bar, okay, toggled open, and understanding, okay, what is happening, okay, between the high and the low. We call it order flow, but it's a transparent look at the buying and selling which is happening inside the bar. So in this particular bar, okay, you can make out, okay, there isn't a lot of demand, which is why, okay, at the close, okay, we were sliding lower, not by much, but hardly about 40-50, but it was a lot of those early greens which were booking profits. So what we were looking at today in this is the order flow chart. I'm just giving you an example, okay, of why we expected the market, okay, to move up. So if you can see, okay, this is the activity today. Even in that drop early in the morning, if you look at the cot, okay, was green, and into the session today, the entire day, some of this, okay, was rollover. There was a little bit of profit booking which happened here, but we were significantly knowing, okay, that this market, okay, would rise, because, okay, the entire thing, okay, was driven, okay, today by a lot of good demand, right? Now some of this again is rollover, some of them is again rollover, okay, and some of this volume, okay, did not come into June contract. So from tomorrow, okay, we start on a fresh slate again. But for the purposes of today, okay, was easily a day, okay, because, okay, you saw a lot of demand. That's why, okay, I did mention that call writers were not safe, and the market, okay, had every inclination to go up. So some of this demand has come off at the close. So there was some booking, which is why we didn't get that last 50-point move higher. But apart from that, this is the way, okay, you can look at whether the demand is higher or whether there is buying or selling happening over here. Just to answer that question, so if you look at that VPOC, you can look at the VPOC of this bar. This is the yellow marked, and this is the VPOC of this bar, and within this you'll find 456 sellers and 1999 buyers. So out of all that traded in this bar, the VPOC, okay, shows you, okay, that there was a lot more buyers coming in, which is why, okay, we rose further up. Right now, this is the order flow. This is the advanced way of looking at the volume point of control, just toggling it right open and looking at all the buying and selling which is coming. Right now, I'll open the floor, okay, to any more questions, okay, you may be having. Please feel free to ask. So we'll give it about another 10 minutes. Any questions, okay, you have, even apart from VPOC, we can take them over here. So the question is about gamma. So gamma, okay, is not really, okay, a really deep topic. It is a very important tool, but to understand gamma, okay, you first, okay, have to have an understanding about delta, and delta is the heartbeat of the option chart, right? So what is gamma? Gamma is delta of delta. Okay, the purest form of delta is gamma. It is the reason, okay, the delta of the option accelerates. And if you can watch, okay, the gamma, okay, you would, okay, get to know easily, okay, how much, okay, the market, how much the option, okay, is expected to move. If you want, okay, we can do a session on gamma as well, okay, and we will cover it in a lot more detail. But we have, okay, all these tools already out for you. So guys, okay, just people, okay, who are new, okay, to us, what we do is at VTrender, we do not believe in reinventing the wheel, right? Whatever, okay, is commonly available outside is available outside. This is a program, okay, we developed for people, for traders who want to know a little bit more. All right. So if you are happy, okay, with what you're doing outside with your open interest and your other indicators, etc., fine. Okay, you're happy, you're making money. Okay, that's the end of it. But if you're looking, okay, for a little bit more refinement, if you're looking for a little bit more advancement, or if you have questions, okay, about your trading, okay, which you have not been able to get answers for so far, okay, then we have a place, okay, for you over here. We have, okay, taken the entire universe of trading, okay, onto another level, and there are a lot more changes, okay, which we are intending to do as we go along. Like I said, okay, it's not the same wheel, okay, which you've been used to. There are concepts here like order flow, and the way, okay, we approach order flow is very, very different, okay, from the order flow used outside. There is a concept, okay, called spectrum. There is a concept, okay, called gamma. There is a lot more, okay, things, okay, which we have been basically doing for a large number of years, and which are now, okay, available, okay, to everyone else out over here. So the question is, what is the difference between COT, VPOC, and DOI? I think search of Google will answer that question better for you guys. Like these are basic questions, and these need to be cleared for you before you put any money to work, right? Just to answer that question, DOI is developing open interest. Do a Google search, and they will tell you how you can find open interest. VPOC is the volume point of control, like I've been saying, the area where the majority of trade happened. And the question about COT, COT is what? COT is the net of all the buying and the selling which has happened in the bar, right? So if you say that this is order flow bar, and what is order flow? Order flow is nothing but demand and supply. So the green, the one on the right, would be your demand, and the one on the left is your supply. Right? It will show up whenever it is in pink. It will tell you that there is supply on the left side and demand. Now this is just a representation of the demand and the supply which is happening. This is called an order flow bar. What is an order flow bar? It is nothing but your candle. This is your candle right to the left of it, right? We have not taken the candle out. We have put it at the left, right? So all our candles are right here. But what is an order flow bar? An order flow bar is nothing but your candle toggled open. So what you're seeing is what is happening between the high of the candle and the low of the candle. And what you're seeing is also what is happening between the open of the candle and the close of the candle, right? So if this is the high and the low of this candle, and that is 22,647 and 22,582, what is order flow? Order flow is just telling you what has happened between the high and the low, right? And this open was here and this close was here. It is also telling you what happened between the open and the close, and indeed what has happened in the body of the candle. That is order flow. It's a market mechanism. There's nothing complex about it. Think of it as a candle which is thrown open, right? Now if this is order flow, what is COT? COT is the net of all the demand and the supply of the bar. So if all of the order flow candle has got a certain amount of demand and supply, then COT is the net of that demand and supply. And if the COT is green, that means demand is outstripping supply in the bar, and that is why price is probing higher, right? And if the COT is red, like in this case, that means there is more supply in this bar than demand, and that is why price has to move lower. Now there are complexities at work. The market cannot be put into a box and said that this is it. So this is not a 10 out of 10 kind of a formula, but 8 out of 10 times this is the way the market works. There'll be 2 out of 10 times where you would not get it perfectly right. That's all right. The market is not supposed to work with 100% efficiency at all times, right? So I hope it explains. Try to not look at everything in terms of an indicator. We are not here I'm talking about indicators, etc. This is a look at what the market is doing. It is a representation of market activity, right? And the best way to look at market activity is to look at what is happening inside a price bar. And the second best thing you can do is understand what is the volume which is moving that price bar. Any other questions, guys? So the MO chart, you will find at the forum section of vtrender.com. If there are any more questions, please feel free to ask. So the question is, what is the logic behind green candle and negative delta, or red candle and positive delta? It is a good signal to trade. So first and foremost, when you're looking at order flow, you're taking the candle out, which is why our candles are on the left. So there is no relation between the color of this candle and what is happening inside the candle, right? Just to put it simply, how do you get the color of a candle? Now just hear me out if you can. If this is your candle, how do you get this color green, or how do you get this color? Right, let me try drawing that again. If this is your candle, how do you get the color green and how do you get the color red? So these are two candles, right? So let's say, okay, this is the high and this is the low. And for this candle also, this is the high and this is the low, right? And this is the body of the candle. So if the open was here, the low is here, the high is here, and the close is here, what color is this candle? It's green, this color, right? But the exact same candle is right next to it in the next minute. The high is here, the low is here, but this opened here and this closed over here. Now what color is this candle? It becomes red, right? It's all determined. It is all determined by where the open and the close are relative to each other. That gives you the color of your candle. If the close is higher than the open, then the candle is green. If the close is lower than the open, then the candle is red, right? So when you're looking at order flow, you have to go beyond the simplistic measure of understanding market activity. The close and the open do not tell you what has happened inside the bar, right? What tells you what is happening inside the bar is the demand and the supply within the bar. And the faster you move out from this concept, especially in derivatives trading, and you understand that the market runs on demand and supply, the more money you're going to make in the markets, right? Before the rest of the market catches up with it, right? So I've given you something to think about. I hope you guys can think about it and start making amends. But to answer that question, the color of the bar is insignificant, because the demand and the supply, they drive everything. Any more questions, guys? Okay, so let's call this session to a close. I hope I've given you certain things to think about. There will be a recording of this posted on the same channel. You can pick it up on YouTube as well. And if you have any follow-up questions to ask me, please feel free to do so. Our mission at VTrender is to empower traders to think right? We say that with knowledge and information, that is the gateway to collecting experience. But what really happens in the world of trading is that half knowledge and no knowledge gives you bad experiences, and bad experiences lead you to bad results. And bad results means that you are blaming everybody but yourself. But the truth of the matter is that you have zero knowledge or half knowledge, and that is giving you bad experiences. So the best way around is to collect the right set of knowledge and to collect the right set of tools which are going to give you good experiences, because good experiences are going to give you good results, and good results are the way to go about in trading, right? So with this, I'll call this session to a close. And if you have any more, please feel to reach out to us. Thank you for coming in, guys. And I wish you the best for the important series of May, which is coming up. Thank you for coming in.